Imagine earning thousands every month without a 9 to 5. What if your investments could pay you every single month, covering your bills, funding your future, or even replacing your paycheck? Sounds too good to be true, right? Well, it's not, if you know the right strategy. Today, I'm breaking down two powerhouse ETFs, SCHD and JEPQ, that could generate thousands of passive income, all while building long-term wealth. Most people think investing is complicated, risky, or only for the rich. But what if I told you that with the right approach, you can start small and scale up over time, creating a steady income stream that grows automatically? Why this video is a must-watch. I'll show you exactly how much you need to invest to replace a full-time salary. We'll break down real numbers, no hype, just facts. You'll learn how to structure your portfolio for maximum income and growth. By the end of this video, you'll have a clear blueprint to start generating passive income, whether you want to supplement your job or work toward financial independence. Stay with me because missing even one key detail could mean leaving thousands of dollars on the table. Let's dive in. SCHD serves as the cornerstone, concentrating on companies with a consistent history of dividend payments, thereby fostering long-term wealth accumulation. As of December 31st, 2024, SCHD achieved an annual total return of 11.67%, reflecting its steady performance. JEPQ is engineered to generate substantial monthly income through a covered call strategy, converting market movements into dependable cash flow. In 2024, JEPQ delivered an impressive total return of 24.85%, underscoring its income-generating potential. When combined, these ETFs can create a financial mechanism with the potential to match or surpass your regular earnings. We'll delve into the specifics, analyze the performance metrics, and provide a comprehensive guide to implementing this strategy effectively. Chapter 1: In-depth analysis of SCHD and JEPQ. First, let's examine the distinct advantages of these ETFs. SCHD acts as the reliable anchor of your investment portfolio, targeting well-established companies known for their consistent dividend payouts. Notable holdings include industry leaders such as PepsiCo, Verizon, and Merck. With an exceptionally low expense ratio of 0.06%, more of your capital remains invested, enhancing growth potential. On the other hand, JEPQ, the JPMorgan Nasdaq Equity Premium Income ETF, is tailored for investors seeking elevated monthly income. Employing a covered call strategy, JEPQ capitalizes on market volatility to generate income. By strategically allocating investments in both SCHD and JEPQ, you can construct a diversified income stream that not only provides regular cash flow, but also offers the potential for capital appreciation, potentially rivaling traditional employment income. This approach empowers you to take control of your financial future, leveraging the strengths of both ETFs to build a resilient and prosperous investment portfolio. Envision crafting a revenue stream so substantially that it challenges your regular paycheck. By combining two standard exchange-traded funds, ETFs, Schwab U.S. Dividend Equity ETF, SCHD, and JPMorgan Nasdaq Equity Premium Income ETF, JEPQ, this goal becomes attainable. These ETFs are not your typical investments. They form a dynamic duo that aims to maximize growth and income. Chapter 2: The numbers. How much can you earn? Here's where things get exciting. Let's break down the potential income from a $500,000 portfolio, evenly split between SCHD and JEPQ, $250,000 in each. Income breakdown: SCHD, 3.5% yield, $250,000 investment. Annual income, $8,750. Monthly income, $729. JEPQ, 10% yield, $250,000 investment. Annual income, $25,000. Monthly income, $2,083. Total passive income, annual, $33,750. Monthly, $2,812. And remember, this income's generated without touching your initial investment. To put that into perspective, The median full-time salary in the US before taxes is about $40,000 per year. That means this ETF strategy could cover a significant portion of your expenses, possibly even replacing a paycheck over time. Chapter 3. Generating nearly passive income even after taxes. Once taxes are taken into account, this investment approach could still bring in an income flow comparable to a full-time paycheck. And the best part? You don't have to do a thing. But let's tackle a key factor: tax efficiency. How do taxes affect these ETFs? SCHD's dividends are largely qualified, meaning they benefit from a lower tax rate, typically 15 or 20% based on your tax bracket. This makes SCHD a cost-effective way to collect passive earnings. JEPQ's payouts, however, include both dividends and income from covered calls. While a portion is taxed as ordinary income, it still remains relatively tax-friendly, particularly when held in a tax-advantaged account like a Roth IRA. Bottom line, this combination helps maximize after-tax returns, keeping more money in your hands. The bigger picture: income plus growth. This isn't just a one-time setup. Expanding your portfolio or reinvesting dividends can significantly amplify these results over the years. SCHD, a stronghold for steady growth. SCHD has consistently delivered outstanding long-term results. Over the past decade, it has appreciated by more than 175%, proving to be an ideal mix of dividend reliability and portfolio expansion. But there's another advantage. SCHD selects financially solid companies that consistently increase their dividend payouts. Dividend growth rate. On average, SCHD's dividends have climbed by more than 10% annually, meaning your income won't stay stagnant. Why does this matter? If this trend continues, your yearly dividends could double within 7 to 8 years, even without adding more capital. JEPQ, high reward monthly payouts. Unlike SCHD, JEPQ focuses on generating strong monthly cash flow while still holding top-tier tech companies like Apple and Microsoft. Growth potential. Even though JEPQ's covered call strategy may slightly limit big gains, it still offers a piece of the NASDAQ 100's upside. Reliable income flow. With an attractive 10% plus annual yield, JEPQ stands out as a powerful income generator in any market environment. The real game changer: reinvesting dividends. Here's where things truly accelerate. Taking a portion of your $33,750 yearly income and putting it back to work. Instead of withdrawing everything, reinvesting into SCHD could dramatically increase your portfolio size, as both your holdings and dividend payouts continue to grow. Over time, this cycle could multiply your income stream, all while keeping a steady cash flow for expenses. This strategy isn't just about making passive income, it's about building a long-term financial engine that could one day replace a traditional salary. Generating wealth today while securing tomorrow. This approach isn't just about bringing in cash right now. It's about establishing a long-term financial strategy that positions you for even greater prosperity in the future. By blending steady income with portfolio expansion, you're creating an investment framework that works continuously in your favor. Chapter 4. Managing Risk, a smarter investment blueprint. Every financial decision comes with some level of uncertainty, but the advantage of merging SCHD and JEPQ lies in how they counterbalance each other's vulnerabilities, creating a more resilient investment structure. SCHD, the pillar of stability. Consider SCHD as the foundation of security within your portfolio. It prioritizes strong, well-established corporations with a history of steady performance. Consistent dividend growers. Focuses on firms that routinely reward investors, even in unpredictable market environments. Financially robust businesses. Invests in companies with strong cash reserves, low debt levels, and durable revenue streams. Proven resilience. Includes corporations that have historically navigated economic downturns and emerged even stronger. This makes SCHD a solid core asset, providing a combination of reliable dividends and long-term value appreciation. JEPQ. High cash flow with built-in protection. In contrast, JEPQ operates in a different financial space, tied to the Nasdaq 100, which consists primarily of tech-driven enterprises and tends to be more volatile. Exposure to leading tech innovators invests in Apple, Microsoft, Amazon, Nvidia, and other high-growth giants. Covered call strategy generates recurring income regardless of market conditions, helping to offset potential losses. Market volatility buffer. While technology stocks can experience sharp fluctuations, JEPQ's unique design enables it to maintain a steady revenue stream, even when the market is uncertain. By incorporating both SCHD and JEPQ, your investment approach becomes diverse and well-balanced, reducing exposure to extreme market swings. SCHD ensures reliability and gradual expansion. JEPQ delivers substantial monthly income while managing risk. This strategic pairing guarantees that even if one asset encounters challenges, the other helps maintain stability, keeping your financial plan on track. Chapter 5. Establishing realistic financial objectives. Now let's take a real-world approach. Can this investment strategy completely replace a traditional paycheck, or does it serve better as a secondary income stream? Total income replacement versus supplemental earnings. The answer depends on your financial aspirations, starting capital, and comfort with risk. If you hold a larger investment portfolio, $1 million plus in assets, the revenue produced from SCHD and JEPQ has the potential to fully substitute a salary. For smaller portfolios, this structure can act as a robust secondary income stream, covering recurring expenses or accelerating financial independence. Regardless of where you begin, combining these ETFs provides a scalable roadmap, allowing you to grow wealth while securing passive income for the future. How much do you need to replace a $40,000 salary? If your goal is to fully replace a $40,000 annual paycheck, you'd likely need between $600,000 and $800,000 invested in these ETFs. Why the range? Several factors determine how much you actually need. Taxes. Your after-tax income will depend on whether your dividends are qualified SCHD or ordinary income JEPQ. Lifestyle choices. Do you live in a high-cost area? Do you want extra security for unexpected expenses? Safety margin. A larger portfolio provides a cushion for market fluctuations and allows flexibility for reinvesting. At this level, a 50-50 allocation between SCHD and JEPQ could generate enough income to match or exceed a full-time salary, often with additional funds left over to reinvest or cover financial surprises. What if you're not there yet? Even with a smaller portfolio, you can still create a meaningful secondary income stream. With $250,000 invested, you could collect over $1,400 per month in dividends. That's enough to pay a mortgage, cover major expenses, or boost your savings, all while keeping your regular paycheck for other financial goals. And here's where things get even more powerful. This income isn't static. Reinvesting dividends allows your portfolio to compound, increasing future payouts. Both SCHD and JEPQ have potential for dividend growth, meaning your income could rise over time even without adding more capital. Whether your aim is to completely replace your salary or simply add financial flexibility, this ETF strategy can be tailored to work for your specific goals. Chapter 6. Getting started. A simple plan for investing. So how do you actually begin building wealth with SCHD and JEPQ? Step 1. Determine your starting investment. If you're new to investing, even starting with $1,000 can set the foundation for long-term growth. The key is to begin now and then increase your investments over time. Step 2. Choose the right account. Tax-advantaged accounts, if eligible, consider a Roth IRA where your earnings grow tax-free and withdrawals in retirement are also tax-free. Taxable brokerage accounts. If you've already maxed out retirement contributions, a standard brokerage account allows full flexibility, though some dividends may be taxed differently. By taking these simple but effective steps, you can set yourself on a clear path to financial independence, whether your goal is supplementing your income or replacing your paycheck entirely. Effortless wealth building through automation. One of the most powerful tools in investing? Automation. Set up recurring contributions to SCHD and JEPQ, ensuring you're consistently growing your portfolio without needing to manually invest. Reinvest earnings to harness the power of compounding, allowing your wealth to multiply steadily with minimum effect. Patience and consistency lead to success. Market shifts are inevitable, but those who stay the course reap the rewards over time. By committing to your strategy and resisting short-term panic, you set yourself up for long-term financial success. Let's connect. What are your investment goals? Are you ready to take action, or do you have questions about how this strategy aligns with your financial objectives? Drop a comment below. I'd love to hear from you. If you found value in this breakdown, don't forget to tap the like button to show support, subscribe for more strategies on wealth building, share this with someone who could benefit from financial growth. Financial independence isn't just about luck, it's about having the right mindset and the right investment strategy. SCHD and JEPQ might just be the missing pieces to your financial puzzle. Thanks for tuning in, and I'll see you in the next video. Here's to your investing success. Profitable investing.